Amy, I remember the first time that I learned about inflation. I must have been about sixth grade, and I was reading a book that was written for that age range. It was about Germany between World War I and World War II, and it was explaining how Hitler came to power. And I remember it talked about hyperinflation in post-World War I Germany. The book said that people would shop for bread with wheelbarrows full of cash. That image stuck with me, and every time I hear the word inflation, I see that little cartoon from the book in my head with somebody with a wheelbarrow full of cash running to the bakery.
Wow. And, honestly, that's a tough first image. I would imagine that did leave a lasting impression. And I know for me, I remember the great inflation of the 1970s and 80s and, some of those financial patterns that got woven together. And we've learned from some of our previous episodes that we're all interconnected when it comes to how the market impacts us.
So this is possibly the most immediately applicable topic we've ever talked about.
I think you're right. Absolutely. So obviously, Holland, you and I are not the experts when it comes to finances. We've learned.
Right.
We have learned a lot on our podcast, but we are not the experts. So we needed to get someone here who could really help us unpack this topic and get to the bottom of inflation and how it affects our lives and our personal stories. So we have invited Dr. Robert Hartwig. He's the Director of Risk and Uncertainty Management Center and Clinical Associate Professor at the Darla Moore School of Business at the University of South Carolina. So we're so glad to have you.
Very glad to be here.
Yeah.
Hi, I'm Holland Webb.
Hi, I'm Amy Boland.
And you're listening to The Afterword, a conversation about the future of words.
I don't know if being a finance professor was the fulfillment of a lifetime goal for you, or if you came to your profession another way, but in just 60 seconds, would you mind sharing the Cliff Notes version of your life and who you are?
Well, sure. I am originally from Massachusetts and went to the University of Massachusetts as an undergraduate and set out to be an academic by doing a PhD, ultimately at the University of Illinois. But then I wound up taking a 25-year detour in government, but mostly in the private sector, actually, 23 years in the private sector and about 2 years in government. And in government, I worked in a regulatory agency as a statistician. I'm actually trained, I'm a PhD in economics and mostly worked in the area of financial economics and econometrics, so basically statistics. That was a good start for me as I began in a regulatory government agency out in Washington, D.C. And then about 2 years in, I went into the private sector. I thought I was going to go into the academic world. As it turns out, I'll be totally honest with you, it was way more lucrative to go into the private sector. So I was an economist at heart, apparently. And what I thought would be a couple of years wound up being 23. But I always said to myself that at some point I would transition into the academic world. My last kid went off to college herself, and that was my jumping off point. So I had always kept an arm and sometimes a leg in the academic world and participated in academic research and conferences and worked to fund it while I was in the private sector. So I had a number of opportunities, and for me, University of South Carolina was a great fit.
Wow, that is quite the journey, but it sounds like everything in your financial history has lined up.
Well, it kind of is. I will tell you that ever since I can remember as a young child, I was always interested in money. I was interested in making money, but not from, say, a pure perspective of being a greedy. Also trying to understand how is it that an economy works without really being able to understand it. And I will tell you that when I was a kid, again, I was doing odd jobs everywhere, mowing lawns, painting. But one of the jobs I had that was the most influential, I'm going to date myself, but for many years I was a paper boy out there on my bicycle early in the morning. So you manage your own business effectively doing that. But the other benefit of that is I don't think is well appreciated is at a very young age, I read the newspaper from cover to cover. And that included the business section, but also things related to politics and geopolitics. And so that combination of seeing what was going on in the world, tying that to what was going on in the political environment, when there were military conflicts around the world. And I became very interested in history, this sort of way, in economic history. And one thing I've learned for sure is as I look around at the landscape today, where inflation is elevated, where there's a lot of political rancor, or where there are wars going on in various places around the world, this in every respect reminds me of the time when I was a paper boy and the Vietnam War was going on. And we had high inflation, and it was the post-Watergate era. So it was a very politically contentious period of time. So as Mark Twain once famously said, he said, history doesn't repeat itself, but it rhymes. And that's true whether it's economic history or political history or anything else. And I think, one way to be a great economist is maybe to be a great mathematician. Another way is to be able to tie the thread of economic and global history together over time and then use that in your profession. And particularly now for me, when it comes to teaching students, having that historical perspective. I mean, even in class today, I spent a few minutes on 9/11 because that was this weekend. And that was a very important event, not only in military history, but economic history for this country.
Oh, my goodness, Holland, this is going to be a fantastic conversation. I can tell already because I am loving the stories and, absolutely connects to the history and that piece of, we're all interconnected, whether financial history, military history, political history. It's such a great point, Robert. All right. So because we have really found that our listeners appreciate a level playing field, let's get some terms under our belt because we are hearing some of these and oftentimes they get thrown out. Like everybody should know what this means, but maybe we're not using it in the right way. So the first term we're going to try to unpack is inflation. What is it?
Right. So let me just keep it simple. So inflation refers to changes in price levels. And we measure that in the United States and in other countries. The federal government undertakes a monthly survey. And what it does is it looks at a certain basket of goods and services, meaning it looks at the price of gasoline and the price of chicken and the price of getting a haircut and the price of visiting a doctor, thousands and thousands of items. And it looks at how those change month to month. And basically, there's some mathematics behind it. Essentially, it looks at, what did this basket of goods cost in August of 2022? And what did it cost in September of 2022? We compute that change month to month and year to year. Usually the way that we measure inflation, the sort of headline number that you hear is kind of the year over year sort of a number. So the new numbers came out on September 13th, the day we're recording this. And it showed that inflation year over year was up 8.3%. That was down from a 9.1% peak back in June. But it certainly was not falling as much as people would have hoped it would, not as quickly. But so just think about inflation as the pace at which prices change over time. There is the opposite of inflation, which is deflation, which can be the pace at which prices fall over time. It's just that we're accustomed to prices going up rather than going down. But in certain countries, deflation is more of an issue. And in this country during the Great Depression, when the economy is very weak, deflation is a potential issue. And that's actually more dangerous in many respects than inflation. But that's almost for another discussion.
Okay. I love the word picture of the basket. I can see that. I can imagine a basket filled with different items. That is a perfect word picture. Okay. So in your title, I love this, risk management. Who wants to have risk? I don't want any risk. So what is risk management?
All right. So one of the unique features of my job. So I'm an economist. I'm in the finance department where we have a risk management and insurance program within that department. And that's where I spend much of my time. Where I spent many of my years in my career in the insurance world, and risk management specifically, as we teach it here, relates to the identification of risk in organizations, and in identifying ways in which that risk can be quantified. say, for instance, in dollar terms in particular. And what we want to be able to do is assign a price to each particular type of risk. So if I run a corporation and 1 out of every 100 of my workers on an annual basis winds up spraining their ankle, and that costs $5,000 every time that happens, I can calculate the expected losses from that event. The same thing, if I have a fleet of vehicles, I can calculate how frequently those are likely to happen and what they are likely to cost when they happen. So based on that, I can calculate what my cost of risk is for a variety of things that I really don't want to happen in my organization. And this could be things from fires in my factory to workers being injured, but also much more expansively to areas such as losing money, for example, on a fuel contract if I'm an airline. Okay, maybe I bet if I'm Southwest Airlines chief risk officer and I'm betting that oil prices are going to go up and fuel prices are going to go up, but they don't, I'm probably going to lose some money as a result of that. So trying to manage the countless number of risks that we have in organizations. Been no shortage of those in recent years with respect to COVID, with a lot of new and different risks that companies have never really encountered before. The idea is to take an inventory of those risks after you've identified them, quantify them, identify solutions for those risks so that you can mitigate them in some sort of way, remediate them. If you can prevent them, those losses from happening to begin with, that's the greatest thing. But oftentimes that is impossible. So what you try to do is you try to reduce the frequency with which they occur or the severity, in other words, the cost associated with them, preferably both if you can. And then within this risk management process, you monitor to see that the remediations that you've made are actually having an effect. If they haven't, you try to make some sort of adjustments. You identify new risks and the cycle repeats itself. So this is what we call enterprise risk management. And this can apply really to any corporation when you think about it, but also even to an individual or an individual family. Each family you can think about as an organization that has risks that need to be managed. The breadwinner could die. The breadwinner could wind up being unemployed. You want to make sure that a motor vehicle accident doesn't bankrupt you, or that a fire in your house doesn't bankrupt you, or some such thing. So every family, every individual, every corporation has these issues. And you need to identify the risks, quantify the risks, find ways of remediating those risks, monitoring those risks, and then repeat the cycle continuously.
Wow. It sounds exhausting, but it also sounds rewarding if you can find that sweet spot of identification and mitigation and remediation.
It is. And it's very much like making any other business decision. So, for instance, if I am a convenience store and I find out that I'm losing a lot of my inventory to shoplifting. Okay, well, what am I going to do about that? Well, I'm probably going to have to spend some money in order to reduce the losses. So I can think about this in exactly the same way I can think about if I'm a corporation that wants to expand. How much am I going to have to invest, and what are the expected returns on that investment through the life of the project? Right. Well, the same thing if you want to prevent the loss. If there's a lot of shoplifting going on in my store, I could think, well, how much will some security cameras cost? Or how much will a guard at the door cost? And how long will it take back before I earn back the investment that I have made in that equipment or in the guard in order to make it cost effective? So it's exactly the same kind of solution and techniques that you would use for a new project that you use in order to sort of manage losses. Okay,
awesome. Now, in order to mitigate some of that, I would imagine you'd have to have something, the term that's come up is money supply. So what does that mean?
Well, yeah, so money supply is probably almost a self-explanatory term. And you can think about that. Most people will think about this in terms of the number of dollar bills and coins that are floating around out there. And there are some very narrow measures of money supply that include essentially just that. But when you think about the spending capacity that you and I and our listeners have, it's more than just the nickels, dimes, quarters, and dollar bills in our pocket. In fact, we have fewer and fewer of those nowadays. But where do we keep our spendable resources? Okay, we might keep it in the form of deposits in a checking account in a bank or in a savings account. We might keep it in a mutual fund. We might keep it in a stock fund, some sort of equity fund, some sort of investment fund. And as we kind of move beyond ordinary cash in your pocket, you're moving to ever broader measures of money supply. Okay. So the Federal Reserve has these sort of arcane measures of money supply. They call it M1 and M2 and M3. And so if we focus on some of the more middle ranges of money, M2, for example, we could think about this as kind of the cash that an average individual or a business would have on hand or could get on hand fairly quickly by liquidating a very, very short-term asset. Okay. Like a treasury security that lasts 1 month, something like this. So in general, what you want to think about is the more money there is circulating in the economy, the more resources there are available to purchase goods and services. And as we're kind of discussing inflation here eventually, what happened during COVID is with the 6 bailout packages that occurred in 2020 and 2021, the federal government injected a huge amount of money into the economy, if you will. Money that people did not have to work for. It magically appeared in their checking accounts literally overnight on a number of occasions. The same thing for a lot of small businesses. So the money supply expanded rapidly in the economy, but not through earned income, basically through government handouts, if you will, government aid. And so to sort of take us where we're eventually going and to tie this into inflation, if you have more money circulating in the economy and there's no additional supply of things to buy or services to purchase, the natural outcome of that is inflation. And that's exactly what gave rise to the inflation, or part of what gave rise to the inflation that we have today. So just imagine if you, Amy and Holland, all of us suddenly woke up in the morning and we wound up with 5 times the amount of money we had in our checking account yesterday. We think that's wonderful. But if that happened across the economy, as was the case with COVID, and nobody worked for that, no additional goods and services were produced. So what we have is more money, no more supply, in fact, less supply in the case of COVID. So you have a lot of people sitting at home spending their money on a fixed amount of goods. The price of those goods and services wound up going up. Okay. And that's how we wound up with inflation, because the money supply basically increased.
Wow. That is maybe a long answer, but makes it so crystal clear. So crystal clear. That's awesome. Okay, you already mentioned this earlier. I actually looked up the consumer price index for today. That was 8.3 as we're recording, because I wanted to know that information just because, I was curious. Yeah. But you confirmed it, so I'm glad I looked it up. I feel like I've now been validated, so thank you. Explain to us, is that kind of like the basket thing that you were talking about? Consumer?
Yeah, so the 8.3% number for August of 2022 basically says that the price of the basket of goods measured by the federal government, which is pretty much everything you and I might consume, is 8.3% higher in August of 2022 than it was in August of 2021. Now, the pace of inflation has been coming down a bit. July over July, it was 8.5% increase. In June over June, it was 9.1. So inflation is still close to a 40-year high. It is coming down, but not as fast as everyone would want it to. And so the idea here is that Federal Reserve wants to keep inflation at around 2%, or about 4 times higher than that. One way that you can reduce it is to try to slow down the overall economy. And that's what the Federal Reserve is doing by increasing interest rates. The idea being is that is going to decrease demand for housing and new vehicles. People will be more reluctant to spend on their credit cards, to make investments in their home and home equity loans and so forth. Now, this is sort of raising interest rates is a very blunt solution to curing the woes and ills of inflation. What it does is it kills demand. But part of what we've had in the economy is a lack of supply. We've heard a lot about supply chain issues and ships stacked up the ports of Los Angeles and car manufacturers not being able to get chips. And there being shortages of lumber and all kinds of other things and shortages of labor. So what we have very much is a supply side issue as well. So while hopefully those will steadily become unkinked, resolving some of the issues on the supply side, what the Federal Reserve is trying to do is cool down the economy on the demand side.
Okay. So we're using a hammer to address every single issue in our financial.
We're using a very blunt instrument that is only going to address half the problem. That's the issue.
Okay. All right. Our last term for today, recession. I keep hearing that people say this is such a bad thing. We do not want to go into recession. And I remember the last recession. So what is it?
Well, the last recession was actually the shortest one on record, and it was during COVID. It was March and April of 2020, and where the economy cratered for about one quarter and then quickly recovered. But a recession is a prolonged period where there is a general decline in economic activity. Now, a rule of thumb that many people use is 2 consecutive quarters of decline in real, in other words, inflation adjusted gross domestic product, or GDP. That is again a sort of a rule of thumb, but not an official definition. The official body that determines when recessions begin and when they end, which is a group of academics that meet up in Boston every now and then. The National Bureau of Economic Research takes into some other broader considerations. So, for instance, we did have 2 consecutive quarters of declining real GDP in the first half of this year. First and second quarter were negative, not strongly negative, but they were negative. And so many people said, see, we're in a recession. But simultaneously, the unemployment rate was only 3.5%, which is tied with the lowest unemployment rate we've had in the past over 50 years. So it's difficult to reconcile the shrinking economy with a 3.5% unemployment rate. When you look into it, there are a number of statistical aberrations that gave rise to the decline in GDP. And in fact, the decline in GDP is going to be strongly positive in the third quarter of this year, probably close to 3.4%. So is the economy in recession now? The answer is no. Will it be at some point? Probably in early 2023. Yes, we'll probably have a shallow recession, meaning one that doesn't last that long and does not result in an extraordinary shrinkage in overall economic activity, nor will it be accompanied by a sharp increase in the unemployment rate.
Okay.
Recessions come in all shapes and sizes.
I did not even realize that we already had a shorter one. I was thinking back to 2008, right? And all that mess. But it's interesting because what I'm picturing is almost where you take a 2-liter bottle and you shake it and it swishes on one side, swishes on the other side, and it's starting to come down. So I'm wondering if this balance of between recession and inflation, we're going to be coming to back into some sort of balance a little bit from what you were saying.
Well, there historically has always been a view that there is a trade-off between inflation and recession. And this was certainly the popular view among economists in the 70s and 80s, the period of high recession recession and inflation during that period of time. The relationship is maybe not as strong as it used to be. And The reason we've come to believe that is the unemployment rate was very low for many years prior to COVID, below 4.5%, even below 4% for a number of years. And yet the inflation rate never really rose during this period of time. So when I was a baby economist, we kind of believed that, mind you, I went to graduate school in the shadow of the great inflations of the 70s and the 80s. And we always believed that an unemployment rate less than 5% or so would give rise to sharply rising prices. In other words, an inflation problem. Well, we found in the wake of the financial crisis that the unemployment rate could fall below 5%, 4.5%, even 4% without sparking inflation. So what we seem to believe today is that the relationship between inflation and unemployment has kind of changed, and that we can run relatively low unemployment rates without sparking inflation. We're not 100% sure what that is. The Federal Reserve believes the Federal Reserve's comfort zone is it would like to have the unemployment rate somewhere between about 3.7 and 4.1%. It believes it can keep inflation at 2% if the unemployment rate is somewhere in that range. And that's what ultimately it is aiming for.
Okay. Whoo, Holland.
I have learned more about economics and how an economy works in the last 20 minutes than I did in 2 economics classes in college, I think. Because the way you're explaining it is simple and tied to these concrete ideas. So I get what you're saying. But in preparing for the podcast, I ran upon an interview that you did. And you said in that interview, you need asterisks to actually understand what ultimately happened to the economy, talking about what happened between 2019 and 2022. Could you tell us what some of those asterisks are?
This period in history during COVID is going to be very interesting for economic historians of the future. I almost wish I could go 20 or 30 years into the future and talk to audiences at that point in time what it was like to live through that period of time. So there are, young economists today and others who will be able to do that. I'll be long since retired, although I have had the opportunity to talk to students about what it was like to live through the 9/11 period, which was also very economically disruptive. So, but every period of economic history is unique. And just by looking at the raw data for 2020, 2021, where you see a 32% decline in economic activity one quarter and a 33% increase in economic activity the next quarter. You see within a span of 60 days, the unemployment rate go from 3.5% in February of 2020, which was the lowest since 1969, to 14.8% in the span of 60 days, which is the highest number since the Great Depression. All right. So someone who doesn't have a good grasp or an understanding or isn't familiar with what had happened in 2020 is going to wonder what went on here. Okay. And so it's if I were an economic historian or a student of economic history in the year 2050, and I looked at these data, I would wonder, well, what caused this and why? And so I probably will have heard about the COVID pandemic of the 2020s, but I would want to dig more deeply into it and see how was it that the pandemic caused such a collapse in the economy, but then it rebounded so quickly. To do that, I'd have to understand what happened in terms of government policy, government aid packages. That would cause me to do more digging. What did the Federal Reserve do in order to try to increase the money supply, for instance, during that period of time to accommodate the shocks that had happened? And was there too much stimulus? And so was that what caused the inflation afterwards? So there are just so many, as you mentioned, asterisks, there are footnotes. It's going to be a period of economic history that almost every month of that period of time, there's going to be an array of asterisks and footnotes and everything else that to have a full and complete history, understand about what happened, you're really going to need to do a lot of reading. And the reverberations of 2020 and 2021, they're not gone. And they actually won't wash out of the economy, kind of like ripples in a pond. Okay, so you throw a stone into a pond and you get some big ripples, but they ripple further and further outward, maybe not quite as large as those initial ripples, but we will be feeling the impacts of the economic dimensions of COVID through the end of the decade. I distinctly remember telling people that the financial crisis, which began in 2007, 2008, 2009, that the economic impacts of that were so deep that we would be feeling those ripples into the 2020s. And in fact, we were. The Federal Reserve cut interest rates in the mid 2008, 2009 in response to the financial crisis and left them low for a decade after that. And in fact, they were quite low even when COVID began. So every economic event is connected to the next, just like every event in your personal life is connected to the next. You can never completely distance yourself from it. You can't run away from it. There's nowhere to run. There's nowhere to hide. You can protect yourself. You can be cautious in a variety of ways, but you are going to be subject to it just like you are the weather.
Okay. So I'm going to go back to our word that we did earlier, the risk management word. Okay. So, because otherwise it just feels pretty hopeless. We've got all this inflation. You've talked about a little bit about GDP ratio and unemployment and that connection between debt, unemployment, and inflation. Okay. So if I'm looking at this connection, how do we add a little risk management in that? What do we do? Is there any good news?
Yeah. So there's two, let me think about it first talk to you about it first about personal risk management from an individual or a family perspective. You think all these sorts of things that are happening out there. As you go through your life, you have many risks every day. You could be in a car accident. You could lose your job. The food at the grocery store could be 8.5% more expensive than it was a year ago or a month ago. How do you guard yourselves against all these sorts of things? Well, think about the risks that you have. You probably have insurance on your home. You have it on your vehicle. That will prevent you, for instance, from being sued and losing all your assets if you're in an at-fault accident in your car. You have your home, for most people, is their most valuable asset. So you insure it to its full and appropriate value so that it can be fully repaired or rebuilt if it happened to burn down or something else happened to that. Other things that you might do, you have health insurance, hopefully. If you're fortunate enough to have that or can afford it, this will help you pay for illnesses or accidents that happen to you, large or small, whether it's a broken leg, a stubbed toe, or whether it's a major heart attack or a stroke. These are all, so insurance is one way that we protect ourselves against the uncertainties of the world. But against other things, say, such as unemployment, what you want to make sure that you do is you save up money over time so that you have at least, I say, a 6-month supply of cash that you can access to pay your bills if you happen to be unemployed for a period of time through no fault of your own. We could have a pandemic. We could have a financial crisis. None of these are your fault, but nevertheless, you might bear the consequences of it through the loss of your job. Other sorts of things that you could unfortunately die in your prime years when you have dependent children and a mortgage. You take out life insurance for those sorts of things. So our personal risks are generally related to mortality risks. In other words, we die at a time when others are financially dependent on us. We have morbidity risks, which mean we become ill or incapacitated, which in effect impact our ability to earn an income. And we also have longevity risk, which, as strange as it sounds, means we might live too long. Well, why would that be an issue? We outlive our financial assets. So we're not going to be able to enjoy the retirement that we would like. And so through a combination of the purchase of insurance, through savings and investment, making a sound financial plan, budgeting, those kinds of things, we can manage many of the personal risks we have in our life. And we have to constantly keep adjusting that over time.
So, and I appreciate all of those tips because that does give a little bit of hope. How does that risk management help us now that we're in inflation? So
right.
Who is in a better situation with this inflation?
Right. So, can you benefit from well, inflation in general hurts many people, of course. It's going to hurt people who are on a fixed income the worst. So imagine you're an individual who has retired, but maybe is not old enough yet to get Social Security. You're living off your savings for a period of time. Your the purchasing value of your savings is going to decline by, say, 8.5% a year based on the current inflation rate. Fortunately, if you are on Social Security, that is actually adjusted upward each year based on the consumer price index. So you will see a cost of living increase if you are a senior who is on Social Security. But people who are on A completely fixed income are going to suffer the worst. Now, individuals in the current economy right now, there are a number of ways to beat inflation. One of the biggest ways to beat inflation is to ask for a raise. So wages are going up at about a 5.2% annual clip. That's not quite as high as inflation, but people who actually then change jobs are seeing increases in the 9 to 10% range, which is above the rate of inflation. Now, if you're hesitant to change jobs, this is the time to do it because the job market is very tight. There's 2 open jobs for every 1 job seeker out there today. The unemployment rate is still 3.7%. Another way to beat inflation is to actually work a few extra hours, work an extra shift every other week, something like that. Yes, you may have to work a little bit more to keep ahead of inflation, but that's just how it's going to be. If you're going to sit there and not make any effort, you are going to lose your ability, your purchasing power is going to erode. Your standard of living is potentially going to erode. So, but in this, the economy is otherwise relatively strong in the sense that there are jobs out there for just about everybody. Pick up a side gig if you want to at night or on the weekend or at your current job. You're going to have to run a little bit faster to stay in the same place, at least for a period of time. But that is an unpopular form of advice, I will tell you, Amy. Nobody wants to hear that they're actually going to have to work a little bit more just to be able to maintain the same standard of living. Most people want to work less to maintain the same standard of living. But the reality is that's not going to work in the current period of time. Although wage increases are up and eventually, I think by the end of the year, early next year, wage increases will roughly be equal to the rate of inflation.
Okay. Wow. Unpopular, but still hopeful. I appreciate that.
That's right. You know, there's nothing wrong with having a side gig.
That's exactly right. For sure. Well, what's the essential element we need to know to understand inflation and how it impacts us?
Well, essentially, you want a budget for inflation, okay? Understand that if the price of most everything you buy is increasing on average by about 8% or so right now, you need to make sure that you are able to manage those price increases. Now, the average person, the way that they're going to deal with that is they aren't going to go to the grocery store and buy the exact same basket of goods every single week. They're going to look around and say, you know what, rather than buying Starbucks coffee, I'm going to buy the store brand of coffee because it's cheaper. Rather than buying, Tyson's Select boneless, skinless chicken wings, I am going to buy the store brand with the bone in, and these kinds of things. So people are going to make adjustments. So essentially, make yourself a budget. Understand that your dollar isn't going to go as far as it used to, but with some relatively minor changes, it can go very nearly as far. Your purchasing power, your standard of living need not decrease by 8%. By being smart about your budget, conscientious about your shopping patterns, you can, at least for a period of time, be nearly just as well off as you were a year ago.
It's amazing what Aldi can do for you, isn't it?
That's right. Or whether it's Aldi or some people's solution is Amazon, whatever it is, there are opportunities for you to it's essentially keep your standard of living as minimally impacted as possible. Wow.
All right. Well, we're going to get a little bit more into the practical ways of handling inflation in part 2. But for right now, I want to say a huge thank you to Dr. Robert Hartwig, from whom I am learning more about inflation and economics than I have probably ever learned in a single setting. I really appreciate you connecting everything to these everyday examples, because it's giving me, who does not understand math, the ability to say, oh, I get what you're talking about. This was really a helpful conversation. While you wait for part 2, please go to theafterwordpodcast.com and become a subscriber. You can leave us a review on Apple Podcast or wherever you get your podcasts, and tell your friends about us. And as always, you are welcome at our table.